Welcome to our lesson on covered interest arbitrage. Let's explore how traders attempt to profit from currency markets. First, we need to spot an opportunity. We'll compare two forward exchange rates. Using interest rate parity, we calculated the 3-month forward rate should be $1.5577 per pound. But look at this. The market is actually quoting $1.5581 per pound. That's 4 pips higher than our calculation. This tells us something important. The British pound appears to be overpriced in the forward market. When market prices don't match theoretical values, arbitrage opportunities may exist. Let's see how to exploit this. Here is our arbitrage strategy. We will execute 4 actions, all at the same time, today. Step 1. Borrow $1 million for 3 months, at an interest rate of 0.19%. Step 2. Immediately convert those dollars into British pounds at today's spot exchange rate. Step 3. Invest those pounds in a UK bank account, earning 0.6% interest. Notice this is higher than the US rate. Step 4. At the same time, enter a forward contract to sell our pounds back to dollars in 3 months. This forward contract is crucial. It locks in our future exchange rate today, completely eliminating currency risk. Let's trace exactly where the money flows. Follow along with the arrows. We start by borrowing $1 million from a US bank. Next, we convert at the spot rate. $1 million divided by 1.5593 gives us 641,313 pounds. We invest those pounds at 0.6% for 3 months. With interest, we'll have 642,273 pounds. Finally, our forward contract converts this back. At $1.5581 per pound, we'll receive $1,726,000. Notice that all 4 actions happen today. Every single rate is locked in. There is zero currency risk. Now let's calculate our profit. First, we'll ignore transaction costs to see the ideal scenario. Step 1. The loan. We borrowed $1 million at 0.19% for 3 months. We must repay $1,475,000. Step 2. The conversion. At the spot rate of 1.5593, we received 641,313 pounds. Step 3. The investment. At 0.6% for 3 months, our pounds grew to 642,273. Step 4. The forward contract. Converting back at 1.5581, we receive $1,726,000. Here's the final calculation. We receive $1,726,000, and we repay $1,475,000. That's a profit of $251. Completely risk-free. Or, is it? Now let's add real transaction costs. Banks don't trade at mid-rates. They charge bid-ask spreads. For borrowing, banks charge us the higher ask rate. Instead of 0.19%, we pay 0.24%. For spot conversion, we buy pounds at the worst ask rate. Instead of 1.5593, we pay 1.5595. For our deposit, we earn the lower bid rate. Instead of 0.6%, we only earn 0.45%. Each small spread works against us. They compound together. Now the math changes dramatically. We receive only $1,224, but must repay $1,599. That's a loss of $375. The bid-ask spreads completely destroyed our arbitrage profit. Let's summarize the key lessons from covered interest arbitrage. First, interest rate parity links three things together: spot rates, forward rates, and interest rates. Second, when market prices deviate from parity, arbitrage opportunities may exist, at least in theory. Third, and most importantly, transaction costs, especially bid-ask spreads, often eliminate any potential profit. Remember our example. A theoretical $251 profit turned into a $375 loss once we added real-world costs. The bottom line? In efficient markets, free money is extremely rare. Always factor in transaction costs before trading.